According to Forbes, 85% of C-suite executives surveyed use the following investment strategy to reduce or eliminate the taxes they pay on their company stock options. However, only 14% of remaining employees with stock options are taking advantage of the same opportunity, which is unfortunate. As you're about to see, that's a lot of money every year that could be better spent on vacations and early retirement. By the end of this video, you'll discover how this strategy works, why it works, and how to implement it yourself. And the good news is, you don't have to be a financial genius. Let's jump right in with a real-life example. Meet Bob and Susan. Both work for Amazon and both receive company stock as part of their compensation, which is great. They get an opportunity to own a stake in their company and potentially build long-term wealth. However, what many of you may have found out the hard way is that you get taxed twice on your employee stock options, once as ordinary income when they vest and again as capital gains when they are sold. Today I'm going to show you exactly how to reduce or even eliminate the taxes you pay when they are sold just by making a change to how you invest. Let's get back to Bob and Susan. Let's assume they each have a few dollars saved that they would like to invest. Bob chooses the most popular option and invests in an index fund. There's a lot to like about Bob's choice. They're easy, low maintenance, and popular. Index funds also give you diversification since they are a composite of many different industries. But there's one large drawback to index funds. Did you know you don't actually own any of the stocks in the index? You own a share of an ETF or mutual fund that owns the stocks in the index. Why is this important? Let's check in on Susan to see what she decides to do. Susan likes the appeal of investing in an index, and she understands the importance of diversification. However, instead of buying an index fund, she purchases a share of each company included in the index. At the end of the year, both Bob and Susan will have very similar returns, but Susan will have something Bob doesn't: thousands of dollars in tax credits that she can give the IRS to pay for her capital gains. In order to see how Susan did it, it's important to understand that an index is a collection of companies, and regardless of the index, the return is based on an average of those companies. That means that on any given day, some stocks in her basket will be up and some will be down. What do you suppose you should do if one of the stocks in your basket is worth less than what you paid? Hold on and hope it goes back up, or sell? While having hope is wonderful, it's not the best financial plan. It could take years for that company to turn around, or worse, it could fall even further. The more prudent strategy is to sell, and I'll show you why. Let's say you bought a stock a month ago for $1,000, and today it was worth $750. If you sold it, you would get your $750 back, and if done correctly, you would also get $250 in tax credits. Tax credits that are as good as cash when it comes time to pay the capital gains tax on your equity compensation. And if managed properly, your pile can grow to be quite substantial. Just to see how impactful that could be, let's assume Susan is able to accumulate $15,000 a year in tax credits. If she were to reinvest that money into the S&P 500 index at the average rate of return, at the end of 15 years, she will have $534,688 more than Bob. Something important to note before I move on is that this strategy will benefit you regardless of market conditions, meaning if the indexes were down, Bob would have nothing to show for the year, but Susan will still have her tax credits. Let's quickly recap. Step 1 is to buy shares of the companies in the index instead of an index fund. Step 2 is to sell underperforming shares throughout the year. But what do you do when you have sold shares? That's step 3. Suppose one of the companies in the index is delicious Coca-Cola, but Coke stock is down, so you decide to sell. What should you do next? If you guessed buy Pepsi, you are correct. Why Pepsi? You don't want to become overwhelmed agonizing over which stocks to buy. Keep it simple and buy the company in the index that most closely resembles the one you sold. I'll include tips at the end on how to determine what to buy and when to sell. There are a few rules you need to follow first in order to receive your credits from the IRS. The first is the wash sale rule, which states if you sell a stock for a loss, you cannot buy it back for 30 days or you won't get any tax credits. So if you sell Coke and buy Pepsi, don't buy Coke again for at least 30 days. You won't get in any trouble, but you could end up losing a lot of money in tax credits if you don't follow this rule. The second rule is regarding the type of account you're using. A tax-deferred account like an IRA or 401k will not work. It must be a taxable brokerage account. And lastly, be sure to file Form Schedule D at the end of the year. The IRS will want to know how many credits you are using this year and how many you are saving for a later date. The good news is that you don't have to be a rocket scientist to use this knowledge to your great advantage, but it can be time consuming trying to maximize your credits every year. Alternatively, we will be happy to introduce you to a local financial advisor that specializes in this strategy. Just click the link to schedule a complimentary call. I'll wrap up the presentation with common questions and tips. Why try to mirror an index? Can't I just pick a handful of companies I like? You run the risk of losing out on the benefits of diversification. In any given year, some sectors in the market may be leading and others will be lagging, and it typically changes from year to year. You want to stay out of the guessing game. If the index is positive for the year, how do I accumulate tax credits? Great question. In 2024, for example, the S&P 500 finished the year 25% higher. However, during the course of the year, 69% of stocks in the index were down at least 15%. If you follow the strategy, you can take advantage of this opportunity and still see an overall return similar to the index. How do I decide what to buy? When initially building your portfolio, look at the composition of the index you will mirror. Each major index will have 11 sectors, and each sector will have a different weighting. You want your portfolio to maintain the same sector weighting as the index, so when you sell a stock, just replace it with a stock in the same sector. Do I have to buy all the companies in the index? I prefer the S&P 500, but that seems like a lot to track. You don't have to buy all 500 companies, just a large enough basket that you have a good representation of each sector in the index. If you have too few, you will have less opportunity to accumulate tax credits throughout the year. When is a good time to sell? It could be as simple as when a stock is worth X% less than what you paid, or as intricate as monitoring analysts and earnings reports. There's no one right way. Just be sure it's worth less than what you paid and keep track so you don't run afoul of the wash sale rule. Do I have to use the tax credits the same year I acquire them? No, your tax credits don't expire. Even if your stock options don't vest for a few more years, it's recommended that you start accumulating them as soon as possible. You may not have enough credits in 1 year to cover all the taxes you owe. I'm worried about investing right now because of the war, inflation, new administration. My dentist said I should wait. There's always a new reason, but to date the market has a 100% recovery rate, and the earlier you start, the more you can accumulate. We hope you found this helpful. This presentation is not intended to provide specific advice for your individual financial or tax situation. Please consult with a financial advisor or tax professional for personalized guidance.